I know it is a miserable one out there. I was telling everybody that I'm speaking to, and I hate that the theme of the conversation has been weather, but I had been here and had not gone out, and I needed to get something out of the car, and I went out there, and it's just like, oh my gosh. And I'm from Texas, so don't get me wrong. And so I said, let me just try it. I turned it on, 111. It was parked under the tree. Now, mind you, that's temperature, ambient temperature is not 111, but 111. So just miserable. Thanks for coming out. I will apologize only briefly, not a big apology, but our AC in the building has actually gone down, I don't know, I think like 30-40% this evening. It's like real estate. Lena and I were talking about, you don't own real estate owns you. And so our AC went down, not completely, so it's going to be a little bit warmer in here. As a result, we're going to try to keep it brief, concise, and we'll only take intelligent questions, okay? That's it? That's all I get? All right. Anyway, so thanks for coming out. We will start with some updates on the properties. And, well, no, we won't. We'll start with the group of handsome people here, the one who had the fly on his head, and then the guy who's standing behind the DG. But I will bring Darwin on and have him give us an update on some of the things. And then, as usual, I chime in here and there where I'm what they call the color man, right? You know, you throw in color commentary. So, Darwin German, everybody.
Sidekick. There you go. Thank you. No need to do that. Okay, good. And just so you know, yes, our air conditioner went out. We have two 30-ton units, and they're staged. One of those 30-ton units went out, so it's a 4 to 6 week wait. And how much is that? 40 grand?
Yeah, you just don't go to Home Depot and get it off the shelf, right?
Yeah, so we're doing, and then this morning we had some fuses go out that those have to be replaced. The whole thing has to come down for a day, and we're having training in here. Let's see here. A lot of fun. Okay. I like this video. There's 2008.
Is that you?
This is the real estate market in 2008.
Oh. Yeah, I didn't think that was you. It was a little too thin.
Yeah, a lot too thin. Okay. But what's happening now is more like this. Okay, we're not going to sink. We're not going off a cliff, but it is very, very choppy waters. Very difficult to get deals done, and we'll talk about some of that on what we're doing. So, yes, it's rough waters right now, and I thought it was a good visual to put in there. A couple announcements. First off, this Friday night, about 5 o'clock, there's a place called Marty B's, and it's in Bartonville, Texas, if anybody knows where that is. There's a group. We've had Scott Husing, who wrote Echo and Ramadi. He came and spoke, and he actually spoke at our year-end event. And he has a great story. This book is great. And he really loved all his men that worked under him and going through and clearing out Ramadi, which was extremely deadly and really tough. And he lives in California, and one of his guys committed suicide in Florida. This was, 8 years ago, something like that. And so he jumped on his motorcycle and drove cross country all the way out to Florida to be there for the funeral. And he was involved, he started getting involved with a group called Save the Brave. And they did Ride for the Brave as a fundraiser. Because in Save the Brave, what they do is they take all of these first responders, military, etc., and they get them together. And it's even, it's just silly stuff. Fishing trips and just things where they can get together and has anybody been in the military? Great, we've got like 4. Okay. 5? Okay. I'd be like Bill Murray from Stripes if I were in the military. It would not be a good thing. But I really admire them, and all these men and women that get together and they have each other's backs, and then they go home and it's got to take out the cat litter and take out the trash, and nobody gives a shit of everything you did back there. And not all wounds are physical. So they do this and it's really good. And so we're doing that Friday night at Marty B's. They're going to come roaring in on a bunch of motorcycles and have live music, and it's a great place to eat and drink and be merry. So if you want to go there, great, you're all invited. And if anybody is willing to donate to Save the Brave, I'll match whatever your donation is up to $5,000. So we would like to show our support for them. So please, I implore you, go ahead and if you can donate anything, anything helps, and I'll match that for them.
Hey, Darwin, I don't know if you know the statistics, but there are easily one veteran a day committing suicide.
Yeah.
It is just atrocious.
It's absolutely horrible, and they're getting so recruitment's down, everything that's going on, and we need to take care of our veterans before we take care of our own.
You want this, are you going to set something up that we do it through you, or do it just donate to them and show you the procedure?
Either that, or if you want to give me, quite honestly, you can make it out to Dark Corp Management Group, business expense, and then we can go ahead and put it all together and do that for them Friday. So anything you do, I would love to have. Also, a lot of you have been invited, and we've got a few seats left for our Ranger game. It's an appreciation deal for investors to go out there. We rented one of the big suites, holds about 100 people. So talk to Mo or Garrett if you have to find out about tickets, and if you're willing to go, want to go, things like that. Okay, it's a 3 o'clock game against the Dodgers.
Are they going to have the roof closed?
I sure as hell hope so.
Call them up.
We'll have an email that goes out tomorrow.
Okay.
Details for everybody to register.
Email tomorrow, more details. Okay. Okay. Hey, Paul, come on in. Got a microphone?
Right here.
Hand it off there. We've got the infamous Paul Peebles joining us.
Infamous?
Infamous.
Why is that?
I'm not going to go there. Nice. Well, talk about Old Capitol event, and then market update, if you can, on what you see happening.
So did you get my email? That I pushed out this afternoon? Garrett, did you send that over to him? Can you put that over? Is that possible? So the Old Capitol Conference, hello to everybody, I'm Paul. The Old Capitol Conference is in October. It's October 4th and 5th. It is at the Frontiers of Flight Museum. So if you guys have ever been there, that's some place to go see if you haven't.
That's at Love Field.
It's at Love Field. It's our 7th annual conference. Darwin and Julian and the cast of characters with Dark Corp have been there. Have you come to our conferences? I don't think so. We've had them at big events. We've had it at Texas Stadium where the Dallas Cowboys play. We've been up in the stands. We built a whole stage. We had Staubach talk at that one. We've had it at one of the theaters down in Dallas. We've had Coach Lou Holtz spoke. We had the guy who was the president of HEB talking a little bit about their culture at HEB. So we don't really talk a little bit about lending or banking at all, but we talk about different stuff. It's an all-day conference. So if you want to learn a little bit more about lending, but really talk to guys like Darwin to talk a little bit about what's going on with that. So this is our, do you have a sound at all with this? It's close enough. This is our intro.
Here, give. I don't know if that helps.
Ooh, great balls of fire!
Maverick, you just did an incredibly brave thing. But what you should have done was refinance the asset.
Crash and burn, how mad?
You don't have time to think when you're making an offer. If you think, you're dead.
Great acting there. There you go.
Yeah, there you go. Thank you. That was all day at the Fort Worth, Fort Worth Naval Air Station base over there, with our friend Lane Bean, who will be one of our speakers over there. He's always great to watch, and so I want you to see if you can get over to that event. That's always it's a fun event. We have fun. I mean, Larry, you've been there before. Oh, people love it. I mean, we just have a good time. So the one thing is that I want to talk about just for a second, not so much this, but if Garrett has that email I sent to you, to Darwin, German.
Yeah.
Can you pull that
All
up?
the list?
Yes.
I do have that. I just got out of all that. Here
The only reason why I want to bring this up, people say, Paul, how come you're so damn good looking and so smart? And I say, thanks, Mom. And so I want to show you some of the things that I listen to and I read. So, and you can get this from Darwin, but this is some of the things that I think are important to read for. So one, I want you to sign up whenever you have a second. Most of the stuff is for free. And this is the Pensford letter. So I want you to get a subscription to this. This is for free. So this is one of our buddies who's not an economist, but he certainly sounds like one. He follows where interest rates go.
He's also funny. Him and his wife are great.
Yeah, he's
have a
very good. He has a podcast too. So you really want to get onto his stuff. So JP Conklin is his name. So make sure you get you sign up for this and you can get this from Darwin too, or Garrett or Julian. Another thing that I look at here too, and I don't know if how good this didn't come up. It came up for a second, but maybe it comes up again. Yeah, I don't know where it is here. This is called the CRE Daily. I want you to sign up for this too. This is free. This comes in your inbox every day. So it's a CRE Daily. You get a newsletter. It tells you exactly what's going on in the market right now. You want to see what that's all about? And then how many people have a subscription? This is another free subscription to Biz Now.
Hold on a second. Yes, sir.
Is Siri Daily the one with Bull?
Yeah.
That's it.
Bull.
Yeah, make sure you sign up for that. Again, that's free every morning by 7 o'clock. You'll have that. And then Biz Now, you want to get this thing too. And you can have all different places, have it, San Francisco, Philadelphia, Orange County. But you want to pull up the one for DFW. And it talks a little bit about multifamily, but also talks about commercial real estate. So you want to get that coming every morning to you. Again, I'm not trying to inundate your inbox, but this is stuff that I want you to take a look at because it kind of tells you transactions that say are going on in this area. One that you do have to pay for is the Dallas Business Journal. So I have a subscription to that. Maybe that's $60 or $70 a year. That comes every day to your inbox. It tells you a little bit about what's going on, and I think you would enjoy the Dallas Business Journal. One of the things that you may know or may not know is a thing called France Media. And France Media has a website that you can go to, and you can pull this up, and it talks about almost like every deal that's been done. Okay, so that goes in, talks a little bit about, it talks about everything. Industrial, multifamily. It just gives you a sense and flavor about what's going on in the market these days. So think about that. That's for free. And Darwin, I don't know where I'm back here.
You opened that all the way. So
Yeah, okay, there you go. This is something that, whether you want to see it or not, this is the real deal. This is you have to pay for. And this comes for New York, Philadelphia, Los Angeles, Chicago, but there's one for Texas. So this is, I think, probably about $100 a year or so. So it's not that expensive, but it has some great articles and it talk a little bit about what's going on in the market itself right now. Yardi, I'll talk about that in a second, but CoStar, this is the CoStar you have to pay for. That subscription's maybe about $25,000 a year or so. So don't pay for that one. But there's some good stuff in here that you can get for free. Talking about some of the deal activity that we're seeing in the market. And then what I get every Monday, and you can get this from Darwin, and this is across, it's hard to read, but this is across the United States. I see every apartment transaction that's closed in all the major markets of the country. So Austin, Charleston, Fort Worth. So here are two deals right here closed in Fort Worth. It tells me the sales price of the property, the per unit sales price, who bought it, who the seller was, where the property was located at, and then I can go into greater detail, but I'm not going to do it here. I can tell you everything about this deal. If you want to get any information on a transaction you want to take a look at, talk with Darwin and talk with Julian. They can ask me. This subscription is about another $25,000 a year. You don't want to pay for it, but you want to, it's like somebody that, a friend of yours that has a boat. That's the best kind of ownership when someone else has it. So this is where it comes, where we have the subscription. Darwin has the subscription through us. That's it. But here's properties all across the United States, so we know every Monday, every deal that's closed. I think that's interesting. And the last thing I'm going to leave you, and you can get this from Darwin and Julian and Garrett, is just the U.S. multifamily outlook. And you can take a look at that at your convenience. This just came out last month, and it talks a little bit about what's going on in the market itself on multifamily. So that would be something that you can get from Darwin and Julian. So that's the only thing I was going to talk about. Just free materials so that you can get smart. I can't help you in the looks, but I can only get you as smart as I can.
Don't go away. Mo, can you bring me up, please? Hello, 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 hello. Okay, here you go. So, we've known each other many years, and it's funny, when I first met Paul, he said to me, we do, I think you said, a third of all real estate loans, multifamily
Apartment loans, right? Apartment loans.
Yeah, and
Dallas, Fort Worth,
in Dallas, Fort Worth,
Austin, and San Antonio.
and so I said,
Bullshit.
but then I got to know him, and this man's the real deal. So, he's a great resource, and so by all means, follow him. Subscribe to his company's emails, and I want to also let you do a quick little commercial. 2023 has been a tough year. I mean, that goes without saying. How many dollars have you placed for multifamily loans in 2023 alone?
I have no idea. We came out with a flyer last week that talked about that, and I don't really remember. I just know that we did
About $2 million, right?
$2 million? Yeah, just a little bit over $2 million. I mean, last year we did like $1.6 billion or so. So I have no idea what we're doing this year, but it's not good.
No, but my point in saying is that even in troubled times that we find ourselves in, this is the go-to guy.
Yeah, money's always in motion.
Yeah.
So whether you're selling a property, and it's an exchange, you have to buy something, or a partnership is, say, collapsing and somebody has to buy that deal, or there's a new deal that's being brought into the market itself for somebody that hasn't sold a property in, say, 25 years or so, there's always money in motion. Now, interest rates have gone up, and we do believe that we've kind of peaked. We think there's going to be maybe one. The Fed say they telegraphed maybe two by the end of the year, but we think at least one is coming. So I think we've kind of peaked a little bit. I think your stock market, your 401k today in the last 6 weeks is going to tell you that it also believes that interest rates have kind of peaked out a little bit. So we also see that being an opportunity for people to get into the multifamily space to buying a hard asset. As much as we like to brag about 401ks and stocks and things like that, that's a paper asset. Everything that is against that wall right there, those are all hard assets. And that's what we invest in, that's what we lend on to.
Well, again, thanks for all that you have helped us with over the years.
No problem. Make sure you come to that Old Capital conference. Besides listening to the podcast too, I know I'll see Larry there because he always comes. As he says, well, there's usually 500 or 600 or 700 people there. It's always a great event. We always have fun at it too.
Paul Peebles, everybody.
Thank you.
He's referred to as the Godfather here. He knows anytime you have any property, we say, hey, I'm looking at this property. He'll tell me who owned it, who sold it, how long ago, what they paid.
He loaned money on
He loaned money on it. It was to this guy, and he sold it here, and this guy lost it, and this guy screwed up, and this guy made money on it, yada, yada, yada. So he always knows everything, and if not, it's right there at his fingertips. So he's a great asset to us and a lot of help to us. Okay. 1019 in Fredericksburg.
Who's in it?
Who's in Fredericksburg? I was just talking with one investor. He said that's the most amount of money he's put in any deal was that one. And it will end up to the investors being a 24% per year average annual return. So anybody like 25%?
That's something.
Yeah, and we've owned that for 5 years. We did a refinance, so a lot of money already came out, but it's going good. And the reason we're selling that is they're building about, 1,200, 1,500 units down there on the books. And when that happens, there will be rent concessions and a lot of struggle with that. So now's the time to go ahead and sell it, and we'll make a good return, so we move on.
Besides, we're in it 5 years. We've overshot our performance numbers. It's time to ring the cash register.
And again, I think our projection on that was about 16%. And that's pretty much what it is, and we'll end up getting 24% back to the partners on that deal as well. Okay. Iron Ranch, we had a groundbreaking on that, ceremonial. We've got all our numbers finished up, and we're getting ready to sign the loan documents. How far away are we from? A couple weeks from getting those done so that we can actually start going vertical on that property. Everything's ready to go. A lot of design elements that went into it. It's been a lot of fun going through that project. And of course there's struggles and everything, but that's where we are.
And what is our pre-lease percentage? I think we're well over 20%.
Yeah. I think we're closer to 40% pre-leased right now.
So people have already signed leases on something that's just a piece of dirt.
Yep. So good. And that's one of our other partners that's out there that's doing that. We're looking for other locations all over town. Maybe I can convince Reggie to brand it our way, on something he's building. Okay. Update on the Mark. How many people are in on the Mark when it actually closes? Remember those rough seas I was talking about? That's exactly what it is. In the Mark, I think I told you the story. I'll reiterate it one more time. Put it under contract. The seller was selling 2 properties. The other property he was selling, a PFC was buying that. And they said, well, what's that? We don't pay any property taxes. They went, oh my gosh, we're under contract with you guys. We wish we weren't, because we would go do this PFC. Their attorneys, they said, okay, we'll go ahead and start doing that PFC. And without the property taxes, it would increase the value of the property by $20 million. So it was worth taking that swing.
Wait. So very briefly, what he's saying, the PFC structure would have eliminated or abated the real estate taxes, therefore raising our net operating income and the value of the property.
Right. So without the property taxes, that increases the value of the property dramatically. We thought we would go for that, started moving ahead. And the state of Texas decided to pass laws getting rid of the PFCs. And that just happened about a month and a half ago.
Okay, another interjection here. And the whole crux of a tax abatement was that the municipality that the real estate happens to be located in gets affordable housing. So if you're into real estate, you should be reading up on it, Texas is becoming less and less affordable because real estate values have gone up to the point where companies are going, I can't afford to bring my employees here because they can't afford to buy a home. Well, the same thing with rental rates, and so every city is struggling with affordable housing. Well, this would have given 178 affordable housing units. I'm not talking about Section 8. I'm just talking about affordable housing, which means a reduced rental rate to the property. Unfortunately, the state, as Darwin said, stepped in and did some things, and we don't want to make this a class, but this was because there were some abuses in the program. However, the fundamental core of this program was thrown out with the baby was thrown out with the baby with the water, bathwater by the city of Weatherford because they had never done one of these, and they said we're not really comfortable with this. Because there was another program we could have used that would have mirrored the one with the PFC.
Well, after the PFC got killed, there's another program, and we went after that. PHA?
Yeah.
PHA, which did something similar.
But it spooked the city. They weren't comfortable with it, and they said, yeah, we're just a little uncomfortable. No, we're not on board with it. So, long story short, that deal died, and then we moved forward. So, I was able to renegotiate a purchase price of $76,750,000.
Pause right there.
Yep.
We put it under contract at $76,750,000.
$750.
And the appraisal came in at $83 million.
That was the
Well,
yes.
The appraisal came in at $83 million. Then the PFC opportunity came out and renegotiated with the sellers, and the price went to
70. Well, $2.5 million.
$2.5 million above that, about $80 million. And then that died, and property taxes and insurance have gone way up, which lowers the NOI, affects our loan dollars, everything else. And so
I went back to the sellers. I said, look, based on what's happened in the market, insurance rates have gone up. We had underwritten the property at $850 a unit, or as we like to say, a door. The best quote that we were able to get was $1,262 a door, and as high as almost $1,600 a door. And mind you, this is not from one carrier, two or three. We shopped it everywhere. Okay, this is just what's happened in the market right now. Couple that with a appraisal from the Central Appraisal District of $94 million. So we were buying it for $76,750. The 2023 Central Appraisal District value came in at $94 million. That took the taxes from $785. No, that was after from $925 to $2.1 million.
nearly
Taxes.
over double.
So I
taxes.
went back to them and said, guys, it's not going to happen. Sorry, you've been great to work with. You've been nothing but accommodating, professional, but I can't close this deal at this. And I laid it all out. It took me about 2 weeks, but I negotiated the price down to $70,500,000. So it compensated for some of the things that we had to backfill on the taxes and insurance. And now this is the new deal.
Okay, I want to add some color to all that.
Yep, I'm the color man.
I'm going to be the color guy now.
Okay.
Property insurance was never really a big thing. 5 years ago, 6 years ago, we're talking $250 a unit.
Oh yeah, I remember those days.
Now, at least $1,000 a unit, maybe $1,200 or more. Okay, so that's kind of, so we would always do a tax adjusted number when we analyze properties. Now you have to do tax and insurance adjusted because of how crazy that is. Here's the other thing, and this is one of the areas that I protect you, okay? I've got $1 million non-refundable on this deal, okay?
Wait a minute, what does that mean?
That means if we decide not to do it, I lose $1 million in cash. Okay? That's not your money, that's my money. A lot of syndicators will go ahead and raise money, put that and use your money as the earnest money deposit, and if it fails, you guys are out. But that's something, that's a risk that I take. Okay? And thankfully, people worry more than I do. This has been on Julian's back on negotiating this thing and getting that down so that we can get where we need to be to have the numbers work. So it was a big thank you. It was $1 million thank you from me for getting that price down. But now we're in a position to go ahead and do it. Loan app going in, and we've got about 60 days to go ahead and now close this. We're already at about $14 million, and I think we need to raise 18? About $18 million roughly. So
$18,050,000 to be exact.
$18,050,000. But something that we have now that the PFC did not offer is bonus depreciation. So we're looking at about a 50% first year tax deduction for you on your investment because of that accelerated depreciation. Okay. So not only do we have a good return, an appraisal that's higher, and built-in equity, and a good tax deduction.
Hey, Darwin, let me jump in here real quick. I don't want to belabor the point, but the bonus depreciation is huge for everyone. I had a conversation with a very astute, very intelligent new investor in our group that called me up and wanted to know what the new numbers were going to be, and the question was,
Paul? Okay.
hello?
Keep it up, Jim.
Yeah, give me some more gain, Mo.
Hey, Paul, I got a question for you too. Come on.
Hello?
Okay.
Okay. Yeah. Hello. Okay. So the question that was posed to me after I said, well, we are getting bonus depreciation back, and the comment was, oh yeah, but now we have to deal with recapture. And so if you're watching online, my reply was, we don't worry about recapture. And maybe I was a little short-sighted in my answer. I certainly wasn't being flipped, but we don't worry about recapture because we have a 5-year horizon on ownership. And so what we do is year after year, we make additional acquisitions. And year after year, well, not every year, but
Yeah.
almost every year, we have dispositions. And so what we do is we cover the gains from a disposition with the previous acquisition. And so that was my point to that individual, that we don't worry about so much about recapture, because if you have a methodical approach to your real estate investment, which you should, a one-off is not going to make you wealthy. You have to systematically invest over and over. And, you know, I'll pick on Susan, right? Susan has been a long time investor with us, and you know exactly what I'm talking about, Susan, right? You invest, you invest, you invest, the pipeline gets full, it starts coming off this end, then you turn it around, put it back into the funnel. And so that's what I meant by bonus depreciation. I'm not an accountant, although I did stay at a Holiday Inn Express once, but I know there's a cap of 25%, and you know, if you're a CPA, you would know what I'm talking about. I'm not. However, bonus depreciation is huge. Do not be concerned about recapture if you are methodically investing, or should I say reinvesting, in your capital in future deals. Sorry about that.
It's okay. Just to add on to that is, who in here has done a 1031 exchange? Okay. 1031 exchange, for those of you who don't know, you buy a property for $1 million. It goes up in value to $4 million. You don't want to pay a tax on that gain. So you go reinvest it, and then you buy something more higher than that $4 million. The problem is your basis that you paid that $1 million keeps on carrying forward. So if you do a few 1031 exchanges, you could have $20 million in real estate with a $1 million basis. And the longer you kick that can down the road, the bigger your tax is going to be. Okay, that's the problem my brother has. and is that he's been doing 1031 exchanges for 20 years, and he's got basically zero basis. If he sells any of those, massive, 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 massive amount of tax. This acts almost like a 1031 exchange because we go and sell one property, you take those proceeds, reinvest into another one, and the bonus depreciation acts kind of like a tax-deferred exchange because, yes, you're going to pay on those gains, but then reinvesting, you get another big bonus to go ahead and offset that. So that's why you want to keep on turning it, just to keep on hitting his point.
But coming back to the point on the mark.
But you
it's
want to make
back.
money in the first place. Who the heck cares about bonus depreciation? We're not going to make any money.
It's back.
Do you pay long-term capital gains on your bonus depreciation income at the end, or is it? I'm sorry, Steve. Do you pay long-term capital gains, or is it regular income?
Okay, I'm not an accountant, but the way that I understand it is the recapture side of it is at an ordinary income level. Take like if you're taking the deduction now, it's an ordinary income level deduction. And again, I'm not a CPA, so don't take my word on that. But if you take that bonus depreciation now, that goes against your whatever your tax rate is, and that kicks the can down the road, because then you're recapturing it at that same rate, but then you get the bonus depreciation at that same rate. So all it is kicking the can down the road. It's like a tax-free loan is what it is. Okay. Now we've also got a new deal because the mark is only for accredited investors. Who in here is an accredited investor? Okay. Who here is an unaccredited investor? Who does not know?
Wait a minute. The math doesn't compute.
No, it doesn't. That's why I added the who doesn't know.
Right. Okay. So I had about a third accredited, and then only one hand with non-accredited.
Yeah. Well, there was a timid one back there
Okay.
too. Like, I don't want to raise my hand. I'm not accredited. But the mark is only for accredited investors, unfortunately. So the unaccredited.
Well, it's not unfortunately. It's just unfortunately for those that are not.
Right. So we can only have 35 unaccredited investors in a particular deal. So this new one that's coming out, we're negotiating the contract right now, so I don't want to give any details.
No. I'm sorry to be correcting you. It's been negotiated. I've already worked it all out. I'm waiting on the PSA. So we're done. We're not negotiating it anymore. It's
Okay.
done.
Okay. Well, we haven't signed the contract, so I can't let you know what the property is. Nonetheless, great return, less than 10 years old, great location, a projected 17% plus return, actually 16% plus return, and about 50% bonus depreciation, 35 non-accredited. Those are going to fill up fast, so if you want in on that deal, make sure you send an email over to Julian or Garrett and let them know so that they can hold a spot for you for the unaccredited spaces.
And it is in the city of Denton. So great city to be.
Less than 10 years old, good project. Okay. So, like I said, we were going to make this short and sweet. So now we'll just hit some, because it's starting to get hot. I don't know about anybody else. But Paul, I got another question for you. Here, grab.
Yep.
Yes.
Okay. How many transactions do you normally do in a year? Not dollar-wise, just rough.
I don't know, a lot. I don't know, 1,000?
1,000 transactions a year?
Yeah.
Okay, that's a lot. And how many different borrowers do you have out of those 1,000? Roughly.
Well, yeah, unique would be, so the borrower is the entity in the,
Okay,
in the
unique
transaction.
individual sponsors or buyers.
So out of 1,000 transactions, we're going to have maybe, I don't know, 60% are going to be.
So about 600 buyers.
That's correct.
Okay, so that's 600 people out there buying real estate. Out of 600 transactions, 600 buyers, 1,000 transactions. I know you coach everybody very well on what they should be doing so that they're not in a bad situation.
Sure.
But still, there's a lot of properties out there, not the ones that you did, but overall, What percentage of properties are having troubles?
A lot.
A lot. And what kind of troubles are they having?
So they're having problems right now because, so this is a rabbit hole.
Yep.
So I was just going through that that same question that came up from somebody that was asking me the same question back up probably about 45 minutes ago.
Good.
And the reason being is that back about 2-3 years ago, a lot of these transactions were done on bridge loans, non-recourse bridge loans. Larry's familiar with that type of stuff. And so non-recourse bridge lending is kind of a 1, 2, 3 step process. The one step is it's an acquisition, and we're going to do, typically if you came to us back about 2 or 3 years ago, that acquisition was going to probably should be, if you did a Fannie Mae loan, it was going to probably be 45% down, okay? And it was a very competitive market 2-3 years ago. And so if we did a bridge loan for you, instead of putting down 40 or 45% down, you put down 20 or 22% down. So there's a big difference between trying to raise 40% or 45% versus 20%. And again, a hugely competitive market back 2.5-3 years ago. Is I would say a lot of people that came out of the IT business, they wanted to become real estate investors, so to speak. I don't know if you heard me last time I spoke, but I talked a little bit about burning their boats. They came over from the, I would say not Spain, but the ITTville, the technology area, and they took those boats and they landed in the new world, which is multifamily. And they wanted to stay in the new world. They didn't want to go back to IT, the IT business. So they were all in, and they had to buy this deal. And so the seller said, hey, listen, I'm thinking about not selling it to somebody, but if they could raise another $300,000, I will sell that deal to them. And so syndication, that just took 3 more people, 100, 100, 100. And they threw the extra $300,000 into the deal, and now you're in control of the transaction. So hugely competitive that period of time. Dollars were getting cranked up very easily because the syndication method of raising money was very easy at that period of time. It's still fairly easy today, but it was easier back at that period of time. So they raised a lot of money at that period of time. So if you only put down 20%, and the key thing I forgot to mention to you is that, again, if you put down 40%, that's where you probably did a Fannie Mae loan or a Freddie Mac loan, and you did a fixed rate for 7 or 10 years. But if you put down 20%, that was not going to be a fixed rate. That was going to be an adjustable rate tied to a short-term index called, it used to be called LIBOR, now it's called SOFR. And when we were doing these loans back 2.5-3 years ago, the rate was at 3.5%. And 80% leverage, 3.5% it was the interest rate. Because interest rates at that period of time was only 0.05 with a 3% spread in the deal that made my full indexed rate at 3.5%. That was great, but they forgot that index can go up. And so a lot of those loans payments on the annual debt service went up tremendously. And just like what Darwin was saying, property taxes have gone up, insurance has gone up, but the biggest thing is interest rates have gone from 3.5 up to say 7.5, 8% in rate. And so that has put a lot of stress on a lot of these transactions that were done 2.5-3 years ago. And I would say, thank God that in this group with these 2 guys, we don't have that problem. So a lot of other groups have that problem, especially when you have 30 plus years of experience and 25 years of experience. You don't have those type of problems, but other groups that are not so don't have a historical perspective of how that interest rates rose. When I first got in the business, interest rates rose 5% in one day with Paul Volcker. Okay? Not over a period of a year, but like it's done for us right now, but in one day. So that has been putting a tremendous amount of stress on these properties. So, you talk about, and then so if we went back 3 years ago, when these adjustable rates were in the marketplace at 80% leverage, those loans are not for 10 years, those are for 3 years. So we have a maturity that's coming right now. And so there's going to be a lot of inventory coming onto the market for people, not this group, but those groups, that group over there, that have to do something. They have to say goodbye to their property, say goodbye to their equity. And so when we're over here, and this island right here, all by itself, I don't have to think that Darwin and Julian and Garrett, they can sleep at night. A lot of these groups over here can't sleep at night. So I don't know if that was the answer to the question that you asked, but that's what's going on right now.
Okay, Paul, I asked you to expand on this. I don't know why this one's not working as well, but okay. So the headline that has been grabbing everyone's attention have been interest rates. One that grabs my attention and continues to every day is debt coverage ratio. Okay, we might be not exposed. So hear me when I say this. We are not exposed to any variable rate debt.
Oh.
Say, yay, that's great, wonderful. However, the thing that keeps me awake at night is debt coverage ratio. And when we have fixed rate, that's great and wonderful, but what we don't have a control over is our debt coverage ratio because it is impacted by real estate taxes, insurance, operating expenses. Talk about operating expenses.
Well, I think you guys already talked about that. You know, operating expenses on a per unit basis or even annualized basis have gone up tremendously in the last year. I mean, we've been affected here, but areas of the country, especially Florida. I don't know if you've seen some of the latest things in Florida about people can't get insurance even on their homes. They were paying $1,000, now they're paying about $4,200 a year in insurance in Florida on a house. So think of a house now being a unit. We're paying $1,700, $1,800 annually per door on the coast of Texas, of Galveston, all the way down to the tip of Mexico. So we're seeing it right now. And then property taxes, and everybody knows that's in the news. We're still seeing a tremendous amount of property tax, just like your brand new deal. They taxed it, 15% higher than what the sales price was going to be on the deal. So, those are huge numbers. And so when you have loans, like we talked about, that these are adjustable rates, interest rates have gone up. There was high leverage in these deals. Instead of being really 60%, they were at 80%. Operating expenses now used to be here, now they're up here. There's a lot of problems out of the water place. And so we have to reset the valuations of these properties. And that's what's coming on soon, is a lot of these properties are going to figure out. Like I was talking to the guys over at Marcus and Millichap today, and we were talking about deals that they're working on right now. And some of these people have capitulated. The sellers have capitulated. They said, we're done.
Wait a minute. That's a word. Darwin, have you heard me? I have been telling people, I have not seen capitulation yet.
Yeah, it's coming right now.
Yeah.
It's like right now.
Yeah. Capitulation. Tell them, what does that mean?
It means you sell it at what you owe against the property.
They're resigned to reality.
Yeah. So a lot of these guys who came over from the IT world and they sailed away and they burned their ships, they're starting to swim back to IT land. So that's what we're seeing, is a lot of the capitulation in the marketplace.
Well, let's use the mark as an example. Is last January, not this 2023, 2022, they were supposedly offered $112 million for that property and turned it down. Okay, they are realistic sellers. They understood the market and put it on, and that's why we got it under contract at basically $77 million. So they already came down to adjust for the market, and most sellers are not doing that. They're professional. These have been the best people to work with, by the way. They have been spectacular to work with. But they came down from 112 to 77, and now, because of the next correction, another 10% down to 70 million. Well,
Below replacement cost.
Yeah.
below replacement
So
cost.
if that place were to burn down, it's the replacement cost is
Let's
not
even
there.
say, let's just make it even lower. Let's say it's worth somebody that might have paid $100 million for it a year ago and got an 80% loan where they paid $100 million and they had an $80 million loan. Well, now it's worth $70 million. Okay, so first off, all the equity is wiped out, and they've got to come to closing with a check. Either that or raise money, cash calls, et cetera.
Yeah,
So,
and it goes back to those maturities. So we talked about that the loans that we did 2.5 years ago, those were 3-year loans. Those have got to be paid off on year 3. And so that's coming like right here. I mean, that's coming
Now.
right here, like now. And so they're having those discussions with their partners in the deal. They're having discussions with their lenders about what are we going to do? Are we going to try to kick the can down, or hopefully interest rates come down or in the next 6 months to a year? Well, they may come down, but they're not going to do this tomorrow. And the operating expenses are not going to do this tomorrow. So there's going to be a pricing readjustment in the marketplace, and that's what we're starting to see right now. And so just like that example about the mark, I was talking to Bard. He was flying into Dallas this afternoon, and I was asking him, because I have to go out to California next week and speak to 475 investors in Orange County, because I wanted to get some real data about what's going on, what they're seeing. He goes, Paul, there's a deal that Darwin used to own.
Oh, yeah. Do we want to say the name?
No, but we'll say what that person bought that property for. Do you remember?
$39 million.
$39 million. And they put probably about $3 million in rehab to the property. So they were updating the property. And how long ago did they buy it?
2 years ago?
years
Yes,
ago.
2 years ago.
2 years
We
ago?
sold it 2 years ago.
So they had one of those maturities coming at them like a bullet. And so
But these guys are pros.
they're pros.
This is a big
they're
national
small.
company.
Big company. They're not like these independent guys, these little independent syndicators. Darwin's not as big as these guys,
We're near.
but these guys are huge, and they are going to get wiped out.
They're selling it for $37 million. We sold them for $39. They put $3 million into it, and now they're selling it for $37.
And they'll probably get about $35 million for the deal. So although
Reality.
that's what happened.
what's called-
That's capitulation.
Thank you. That's exactly what I was talking
That's
Forced capitulation.
Forced capitulation. Doc.
next year.
Next year, I am anticipating a drop in property taxes quite a bit because interest rates go up, cap rates go up, the property values are coming down, so those should be coming down. So that's a bonus. We're not putting that into our pricing, into our expenses, but I anticipate property taxes going down the next couple of years that will help the overall valuations. So now's time to buy. I don't think it's 2 years now. No, 1 year probably. Yes, sir.
So, kind of similar question on insurance. What's driving the insurance prices to go up so much, and if property values are coming down?
What's driving?
Yeah, so what's driving the insurance costs? So you said insurance costs are going up. Are they still reeling from the froze in Central Texas, or where their loss is coming from?
Okay, yeah.
And then secondly, if prices are coming down, will insurance rates also come down just like the taxes?
Well, this is my theory on insurance. Anybody in the insurance business? I know there is.
Yeah, we are.
Yeah, we
pay
all.
a lot of it.
I'll buy it. Insurance companies plan on losing 5% of the premiums they receive. Let me rephrase. So they collect $1 million in premium. They're anticipating that they're going to pay out $1,050,000 in claims. They make up for that because they've got shit tons of money in the bank that's earning interest on their investments. 2008, 9, 10, prices went up on insurance because they lost a ton in the market. I think that combined with the losses they have now and all of the storms and all the other claims, Uri and everything else, that they have got to make up for, they probably lost 110% of their premium. So they got to make up for that plus whatever losses they may have made. So at least that's my theory. I don't know.
So I have no idea really, but I just have common sense knowledge is that a lot of the carriers have pulled out of Texas that
That too.
insure multifamily properties. They've stopped really insuring some of these older class assets. We've had tremendous losses. And one thing that the reason why our insurance is so damn high is because we have hail claims and wind claims, and you go down towards the Gulf, we have flooding, we have hurricanes, we have all kinds of these. We don't have really forest fires, so to speak, and we don't have mudslides, but we have things that do a lot more damage, on a per capita basis than Nevada or someplace like that, or Indiana. So their insurance rates are low. But just like State Farm pulled out of, I think, California, they've come into Texas, and they have been kind of the low-cost provider until their bucket got filled almost immediately. And so
Which we went to State Farm in a lot of our properties because the rates were so low.
rates they were very competitive. So they had really never been in the multifamily business. They got into the multifamily business. They saw that was a niche. They filled their bucket up, and now they're out. So a lot of these other insurance companies, these carriers, these markets that we would usually go to bring some competition, we don't have any competition. There is no competition. It is, you have two choices. You have take it or leave it. And as a bank, I've got to have you take it.
In California, in Lake Tahoe, they had those fires that came all the way up to South Lake Tahoe. They actually evacuated that city.
Right.
And because of that, a lot of the carriers pulled out of offering any fire insurance. The only carrier that they have is the state policy that they do, but their policy does not include code upgrades and things like that lenders require.
Right.
So as an example, my brother was selling one of his properties. He had $1 million non-refundable on a small property. And the lady that was buying it couldn't get insurance and had to walk away. Because she couldn't get insurance.
Right, and that comes with residential properties in California too, because the insurance is so damn expensive, it doesn't make economic sense. But I don't think it's going to get any worse. In fact, I'm starting to hear it's starting to get a little better in insurance right now, because again, they're taking a sample on the claims that they're up against, and I have lunch with Jeff King over at Raby King next week to kind of figure out exactly what he is hearing when they bring a transaction to the market, because they're brokers. They're going to shop it to 25 different places. So they'll kind of tell us a little bit more about what's going on in the insurance market right now.
Okay. Since you're still up here,
No, go ahead.
I was going to ask about questions.
No, I was just going to say, you may or may not have heard that real estate is a team sport. That's why he's on our team.
Mm-hmm.
That's why he's on our team. And I don't know if you remember those old commercials about the hair club. I'm not only the hair club president, I'm also a member. He's not only the president, he's also an investor. I mean, he's an investor in our deals.
Yeah, this building right here that we're in. I'm one of the largest investors in this deal right here.
Yeah. You're also an investor in Frankfurt Station.
Over in Maui,
Yeah. So,
Yeah?
so,
Yeah.
Hawaii,
so
probably?
out in Fort Worth.
That's what we call a team sport.
Yeah. So I'm like Cy Sperling. Yes, I'm the president, but I also am a client too.
Well, at least
Now-
you got hair.
That's
We have, I told you about bringing on Ben Garland. He's an NFL player, a retired NFL player. And he said, if you're so good, how come I've never heard of you? Well, we don't do the sexy investments. We're not out there we're not promoting that we're going to get a 50% return or anything. We end up doing it, but we don't promote that because we minimize risk rather than try and maximize profit, which is why we have the fixed rate loans rather than the variable rate, and doing those quick flips like everybody else is taught to do is, fix it up, do 10% of the units, sell it with meat on the bone to the next sucker. Well, it was a hot potato situation. Now you've got somebody that's stuck with that hot potato, and they're the ones that's going to get screwed. So we have a long-term view so that we can ride through these, because the values of our properties have gone down as well, but the income is not, which is why I also want to point out Vicky's in the back. Wave, Vicky. And of course, she's running the property management company now, and we have been doing so many things. Our portfolio is doing very, very well. I mean, it's real rough waters, so we can't say we're killing it, but we're definitely, the boat is moving ahead and it's not in too choppy waters. And we are now, by the way, all of our managers we're doing the training here. All of our managers are going to be CAM certified. We are also going to get for all the managers and the maintenance CAMT certification, and are certified.
Don't throw out acronyms like that without letting you know what that means.
Okay, IREM, Institute of Real Estate Management, has programs that they do through the apartment association, et cetera. That's Certified Apartment Manager, which is just an accreditation for them. CAMT, Certified Apartments Maintenance Technician, for our maintenance people so that they're certified as far as being good. Then there's CAP, Certified Apartment Property Supervisors, that we're going ahead and doing. And we're even thinking about having all of our managers become HVAC certified so that they can understand. So the whole idea is have the best trained people. And my dad told me a story one time. He said, would you rather train your staff and have them leave, or not train them and have them stay? So we know that some of them are going to be leaving eventually, and they move on in their career, and we're helping them in that. But we're also building a lot of loyalty, and while they're here, better for all of you guys on making sure that our properties are taken care of. So
Certifications are also nationally recognized.
Nationally recognized.
The National Apartment Association.
Yep. So we're doing all of that to make us better.
And then I think, based on time, unless you guys have questions, I want to leave you with one thing. So you may or may not know, I wear a few hats here in the company. One of them is investor relations, and I get questions every week about distributions, and either whether we've stopped them or when we're going to start them. And what I would leave you with is this. Everything that we've talked about today is education. It's education because a well-educated investor is a good investor. Someone who's ignorant of the facts, and that's not a pejorative. It's the fact that if you're not aware of what's going on, then it's very easy for an investor to be either suspect, critical, or disgruntled. But the fact of the matter is there are forces beyond our control, and Paul has spoken to some of those. Fact is that there are things, the headwinds that we're dealing with on a daily basis. It is a product of years of experience through down markets and up markets. The up markets are easy, right? You know that whole adage about a rising tide lifts all boats. Wait for that water to go down and see who goes down with it, right? So I'll finish with this. If we are not meeting some of our projections or some of your expectations, it's not because we're not doing our job. There are forces beyond our control. We are managing this portfolio, in my opinion, and this is self-serving opinion, very well, because I will venture to say that there are infinitely other groups out there, other sponsors who are unbelievably underwater, and I can go on about tides, and I'm sorry, this is public news, so I'm not exposing ourselves to litigation or anything like that. There are tides, and I could go on and on about major groups who are in huge trouble. We're talking about people who have billions, like not millions, billions of dollars in portfolios that are right now facing some huge problems. We're not exposed to that. And I'm not patting ourselves on the back. I'm just saying that we are staying true to our motto, not our motto, but a motto of don't talk to me about a return of my money until you talk to me a return on our money, okay? We will always look after your investment first, and any profits that come after is secondary, okay? So if we happen to stop distributions, it's for a reason. It's for your benefit. It is not because we're going to stop your distribution and we're going to keep the money. No, that's not it at all. So it is to protect your assets, and real estate is cyclical, and I guarantee you, and I will say this, I will guarantee you that 3-4 years down the road, we will all be talking about 2023 like we talked about 2008, 9, and 10, if you remember that. And then the market just took off, right?
You remember the first couple of deals that we did together? There was no finance. There was no financing at that period of time. The markets were frozen in the capital markets. There was no money. So what we had to do is we had to raise 100% of the deal.
It's all full recourse.
Yeah, there was no banking, no Fannie Mae, no Freddie Mac. Julie and I, this was 2011, 10 or so.
11.
Yeah, so we had to go out there and raise 100% of the equity, 100% of the loan, 100% of the debt. There was no loan.
And he was able to pull it off. But all that to be said is we're looking.
They didn't need me because there was no money.
We are looking after you, and never ever doubt that. Okay.
That's true.
Any questions before we call it a night? Well, I'm impressed. Nobody's gotten up and left. So if there are no other questions, thank you for coming. Have a great evening, and have a great rest of your week.